In 3 simple steps, I'm going to explain the basics of stocks. And by the end of the video, you'll be able to do 3 things. You'll be able to decide whether stocks are right for you. You'll be able to decide what investing style is right for you. And you'll be able to start investing through either your 401k or your brokerage account. Imagine your friend asking you to join him in business as a partner. You have faith in your friend's capabilities, so you hear out the business idea, the way the company can make money, etc. And you're convinced that it's a good business idea. You weigh the pros and cons and then you decide you don't want to quit your job, but at the same time you don't want to let go of the opportunity either. So you say you're happy to invest your savings as a silent partner in return for a fair share in the ownership of the business. You don't participate in the day-to-day operations of the company, but you have a claim to its profits. If things go well, your invested capital appreciates and you stand to gain. And in case things are not going well with the business, you have a right to review the decisions your friend makes in running the business and ask questions. And that's how a partnership works. The same is the case with stocks. And let's see how it compares on the 4 aspects that we just saw. When you buy the stock of a company, you're buying a piece of the business represented by its stock. Your share in the business is determined by the amount of money you put in and the value of the company as determined by the market forces of supply and demand. If you believe the market is giving you a fair deal, you buy the stock. Or if you think the market is not giving you a fair deal, you just don't buy. If the business is profitable and decides to distribute the profits to its investors, then you may get what is called dividends. Or if the company sees a big business opportunity which it can capitalize on, it may decide to reinvest some or all of its profits so that it can grow and become more profitable in the future, in which case it may or may not offer a dividend. If the company reinvests and indeed becomes more profitable, then the market forces of supply and demand will value the company at a higher level and the stock price will go up. On the other hand, if the company doesn't become more profitable, then the stock price will nosedive. Thus, there is the aspect of capital appreciation or capital loss, which doesn't happen when you invest in deposit accounts or certain bonds, for instance. And lastly, you also get voting rights, which is 1 vote per common share typically, which gives the shareholders a say in the company's policies if you choose to exercise the vote. So we can conclude that owning stocks is very much like being a silent partner in a business. And the big advantage of owning stocks is that even with just $1, you can still invest in stocks as you can buy a fraction of a share. To buy a stock, one has to look at its risk versus return characteristics. The total return of a stock is the sum total of the capital appreciation for that stock in a given period of time and the dividend payouts that are received in that period of time. The typical return for stocks in the US is about 10% per year, and after adjusting for inflation, it's about 6 to 8%. Our understanding of stocks would not be complete without understanding why businesses are willing to give up a percentage of their business while issuing stocks, because they can raise the same capital from banks by way of loans and from other investors by way of issuing bonds. The reason is that raising equity capital by issuing stock doesn't give the business the obligation to pay interest regularly as they have to do with loans and bonds. The net result is that shareholders do not have any guaranteed returns from their investments in stocks. Of the many risks, there are 2 primary risks that shareholders need to be concerned with. First is the risk that the business doesn't do well, in which case the stock price goes down. And if the business goes bankrupt, then stocks are given lower priority than bonds. And the proceeds of any fire sale of assets doesn't trickle down to the shareholders. The other risk is when the business is actually doing well, but the stock price is not doing well. This happened to Amazon during the dot-com bust when the price of Amazon dropped from $113 to $6. This creates a trap for investors who think that the stock price is accurately representing the business health of the firm. So one has to train oneself to see the stock price as being different and delinked from the underlying business. So to summarize this section, we saw that stocks return about 10% per year on an average. There is the risk of capital loss while there are no guaranteed returns. So by now you should be able to determine whether this risk-return characteristic suits you. Now let's take a look at the different investing approaches. Investing actively involves stock picking, which is selecting stocks for investing based on the business prospects and profit potential of the underlying business. Just as a sample, stock picking could include the following activities among other things: understanding the business of the company, its customers, products, suppliers, business model, management, etc. Understanding its market, competitive analysis, financial statement analysis, which includes looking at balance sheets, profit and loss statements, and cash flow statements, and also analyzing the financial ratios. Looking at the customer experience and feedback, which includes your first-hand experience with the company's products and services. I know that's a lot, but if you want to be successful at stock picking, you need to pay attention to all these activities and maybe more. Active investors can take different strategies or approaches. Value investing is where you're investing in companies that are worth more than what's indicated by their stock price. As of 2022, Intel and Alibaba are great value picks. In growth investing, you're not so much worried about buying companies at prices which are less than their actual worth, but rather you're looking at buying companies which have a huge potential for growth. In some of these cases, the companies may not even be profitable yet, but they have a potential to grow quickly. Example would be the investments made by the ARK Invest Fund. Dividend investing or income investing involves picking companies that have grown over a period of time and have become stable money-making machines and are willing to share a bulk of their profits with their shareholders as dividends. Examples would be AbbVie, T. Rowe Price, AT&T, etc. The other option for active investors is to invest in mutual funds, where you're essentially outsourcing the stock picking to experts in return for a fee. Investing passively involves investing on the entire market or a segment of the market so that you essentially take stock picking out of the equation. The result is that your returns track the market or the segment returns, and your risk is reduced as compared to the risk of picking individual stocks. The S&P 500 is an index of stocks of 500 companies which are taken as the best approximation of the overall US stock market. So investing in the funds which track the S&P 500 by buying and selling stocks so that they are in sync with the S&P 500 is a good way of investing passively. Example would be the SPY ETF. Here's a trick question. How many stocks are there in the S&P 500? Let me know your responses without Googling in the comment section below. If we may use the term investing in its broader sense, then speculation is yet another form of investing. If you'd like to have a clear understanding of the difference between the pure form of investing and speculation, then watch my other video on this topic. And I've provided a link to it in the video description below. Day trading, where you hold your positions from a few seconds to a few hours, and swing trading, where you hold your positions from a few days to a few weeks, are two examples of stock speculation. And as you can see, these are characterized by short-term operations. The primary tool for stock speculators is technical analysis, which involves the use of charts to assess market sentiment, as opposed to fundamental analysis of the value of the company through its financial statements. Yet another approach to stock picking is to take a hybrid approach where you invest a portion actively and a portion passively, and maybe just some of it speculatively. For example, you may choose to invest your 401k passively, as individual stock picks are typically not allowed in the 401k, and any additional savings that you make actively. Note that we are just talking about the portion of your investment in stocks. You could still have investments in bonds, cryptos, gold, etc. to diversify, which is beyond the scope of this video. So by now, you should be able to decide which approach is best for you. If you are a beginner, you might want to avoid speculation, at least until a point where you built a safety net with your profits. And data shows almost conclusively that passive investors are almost always making better returns than active investors on an aggregate basis. These are just some points for you to consider before you make your choice. Now let's look at how to buy stocks. The best place to start would be your 401k. Your 401k offers tax benefits, and if your employer matches what you invest in your 401k, then it's a no-brainer. Moreover, the 401k typically includes mutual funds and these days ETFs as well, which are considered less risky for you by your employer and financial service provider. So by design, it's a great place to start. On the other hand, if you want to go for stock picking, or if you want to invest in stocks over and above what you could invest through your 401k, then you might want to open a brokerage account. You might want to subscribe to this channel if you want to watch future videos on comparison between different brokerage account options. Before I summarize what we've discussed so far, here's a request. Please leave a comment with your feedback on this video. There are 3 steps to stock investing we discussed today. Step 1, decide if you are comfortable with the risks involved in investing in stocks. High price volatility, and in some cases, complete loss of capital is possible. Step 2, there are 4 investing strategies that you can pick from. And step 3, start with your 401k first and open a brokerage account as a next step. There's just one more step you need to take. As a smart investor, you might want to balance the risks of stocks with the stability of bonds to create an investment portfolio that gives you both the excellent returns and a peaceful night's sleep. And to do that, go watch this video right here, which explains the concept of bonds and gets into 2 inflation-proof bonds that could make sense for your portfolio. If you found this video useful, please hit like and subscribe. This is Senthil with a game of money, discussing investing, business, and careers.